What's something people don't know about value investing? In the world of value investing, we look for bargains. We want to buy stocks for less than what they are truly worth. This true worth is what we call intrinsic value. It's like finding a dollar bill for 50 cents. Intrinsic value is the heart and soul of value investing. It's about understanding the underlying worth of a business, regardless of the current stock price. The stock market is like a voting machine in the short term, but it's a weighing machine in the long term. The goal is to find companies trading below their intrinsic value. This difference between price and value is our margin of safety. Think of it like buying a used car. You wouldn't just look at the sticker price. You check its condition, mileage, and history to determine its real worth. Value investing is the same. We dig deep to understand the true value of a business. How do we determine intrinsic value? We look at four key components: earnings, dividends, assets, and cash flow. Earnings are the profits a company makes. For example, think of Apple and its massive profits from iPhone sales. Higher earnings usually mean a more valuable company. We look at earnings growth over time to gauge a company's future potential. Imagine a startup that consistently doubles its earnings every year. Dividends are payments made to shareholders. Think of it as a reward for investing in the company. They are like bonuses for owning a piece of the company. Consistent and growing dividends are a good sign of a healthy business. For instance, Coca-Cola has been paying and increasing dividends for decades. Assets are what a company owns, like buildings, equipment, and cash. Think of Amazon's vast network of warehouses and delivery trucks. We look at the value of these assets and whether they are being used effectively. Cash flow is the lifeblood of a business. It's the money coming in and going out. Strong cash flow gives a company flexibility and stability. Think of it as having enough money to cover unexpected expenses or invest in new opportunities. By analyzing these four components, we can get a better picture of a company's intrinsic value. Remember, we're looking for companies with a history of strong performance and the potential for future growth. Just like Warren Buffett looks for companies with solid fundamentals and growth potential, we too can find valuable investments by focusing on these key areas. Warren Buffett, one of the greatest investors of all time, is a master of finding undervalued companies. His investment in Coca-Cola in the late 1980s is a classic example of value investing in action. Buffett recognized the strength of Coca-Cola's brand, its global reach, and its consistent earnings growth. He saw that the company was trading at a price below its intrinsic value. He bought a large stake in the company and held onto it for the long term. The result? Coca-Cola's stock price soared and Buffett made a fortune. This example highlights the power of patience and the importance of focusing on intrinsic value. Buffett wasn't swayed by short-term market fluctuations. He believed in the long-term potential of Coca-Cola, and his patience paid off. Value investing is not about getting rich quick. It's about finding undervalued companies and holding on to them for the long haul. This requires patience and discipline. The stock market is like a roller coaster. There will be ups and downs along the way. But by focusing on intrinsic value, we can ride out the volatility and come out ahead in the end. Remember, the market is driven by emotions in the short term. Fear and greed can cause prices to fluctuate wildly. But in the long term, value will always prevail. Just like a seed planted in fertile ground, a well-chosen investment in a company with strong fundamentals will eventually bear fruit. Patience is key to reaping the rewards of value investing. When buying a stock, we want to make sure we are getting a good deal. This is where the margin of safety comes in. It's the difference between the stock price and our estimate of the company's intrinsic value. The bigger the margin of safety, the less risky our investment. It's like buying a car with a big discount. Even if something goes wrong, we haven't overpaid. We calculate the margin of safety by being conservative in our valuations. We assume that things might not go as planned and build in a buffer to protect our investment. This conservative approach helps us avoid losing money and increases our chances of long-term success. Remember, in investing, it's better to be safe than sorry. Intrinsic value. your guide to intelligent investing. Intrinsic value is the North Star of value investing. It's the guiding principle that helps us make informed investment decisions. By focusing on what a company is truly worth, we can avoid the pitfalls of speculation and emotional investing. Remember these key takeaways. Intrinsic value is the true worth of a business based on its earnings, dividends, assets, and cash flow. Look for companies trading below their intrinsic value, providing a margin of safety. Be patient and disciplined. Value investing is a long-term game. By following these principles, you can navigate the stock market with confidence and build a portfolio that will stand the test of time. Remember, investing is not a gamble when you understand the value of what you own.